Most investors think Warren Buffett made money in Coca-Cola because it is a famous brand, but that is only a surface level explanation. Buffett did not invest in just a brand. He invested in a global habit system that converts consumer behavior into cash flow for decades. And if you understand exactly why he invested in Coca-Cola, you will stop chasing good stocks and start identifying real compounding machines. This video is only for educational purpose, not investment advice. And if you want to learn real investing, no tips, no noise, but actual business understanding, make sure you subscribe to the channel and like this video. Because the goal is simple, to build a community of serious investors who understand what they own. Now let's start with a real context. Because timing matters. Buffett did not randomly buy Coca-Cola. He started building his position after the 1987 market crash, when fear was high and valuations has corrected. But here is the real critical point. Many stocks were cheap after this crash. Buffett did not buy only because stock was cheap. He bought predictable superiority at a reasonable price. So what exactly did he see? First, he saw habit, not just demand. Coca-Cola is not a product where customers sit and analyze deeply before buying. It is a low-cost, high-frequency product that is connected with meals, travels, events, parties, restaurants, shops, stadiums, airports, and daily consumption. That repeat behavior creates predictability, and here is what most people miss. Predictability of behavior reduces investment risk more than high growth increases return, because when behavior is predictable, revenue becomes stable. When revenue is stable, earnings become more reliable, and when earnings are reliable, compounding became powerful. Second, Buffett saw pricing power. If Coca-Cola increased the price slightly, most customers do not stop drinking it, because the product is affordable and emotionally familiar. Now think deeper. That small price increase across billions of serving globally can create massive additional profit. This is why revenue growth alone is not enough, because revenue makes a company bigger, but margin expansion makes a company more profitable. Third, he saw a distribution mode. Coca-Cola strength is not only the brand, it is the brand plus distribution. Even if another company makes a global drink, building Coca-Cola's global availability is extremely difficult. A product creates demand, but distribution captures demand. And this is a powerful moat. Fourth, he saw capital efficiency. Coca-Cola does not need endless heavy capital like many industrial businesses. It can generate strong cash while continuing to grow, and that cash can be paid as dividends, reinvested, or used to create shareholders' value. This is why Berkshire's Coca-Cola investment became so powerful, because Buffett was not only looking for stock price appreciation, he was looking for business income from ownership. Berkshire invested around $1.3 billion in Coca-Cola, and over the time, dividend income alone became hundreds of millions of dollars per year. That is not trading, that is ownership. Fifth, Buffett saw global growth runway. He was not buying Coca-Cola only for America. He was looking at the world. What happened when more people in developing market consume Coca-Cola more regularly over decades? That is long-term growth visibility. So the Coca-Cola lesson is very clear. Buffett bought a business with predictable habit, pricing power, margin potential, distribution moat, capital efficiency, and long-term growth runway. Before investing in any company, ask yourself, is this product used repeatedly? Can the company increase prices without losing customer? Are margins improving? Does it have a real moat? Does it guarantee cash? And where will growth come from over next 10 years? If you cannot answer this question clearly, you are not investing, you are guessing. Buffett did not ask which stock will go up next month. He asked which businesses can keep generating cash for decades. That is the difference between a stock picker and a business owner. And once you understand this, you stop chasing moment and start owning compounding. This is where real wealth is built. Thank you very much. Make sure you subscribe the channel, like the video. See you in the next video. Thank you.